referendum was proposed as a way to appease this group and get their votes. Britain, Britain has always been kind of a one-foot-in member of the EU. For example, it's separated by geography from the mainland of Europe, and it's maintained its own currency all along. So they maintain the pound, whereas the European Union is on the euro. The detractors of the membership in the EU cite such reasons as the strict EU rules and regulations, the growing immigration problem, and the perception that more and more people have fallen on the government dole, and also too much control by EU leaders over the UK. The UK has always had some problems. As I mentioned earlier, this group that started, it wasn't just them who were against the EU, but, it's what had been kind of widespread from the beginning. And there's also been problems with the pro-leave camp is not okay with the amount of money that they're spending to pay to the EU, and they paid $16.3 billion in 2014. So why is the Brexit important? One of the most obvious effects of a Brexit will be that it will encourage other member states of the EU to leave it, thus weakening the idea of a unified Europe. Economically, half of the UK's exports go to the EU, while over half of its imports come from the rest of the Union. So a Brexit will mean that all that trade will undergo a fresh negotiation. And its exit also will mean that the EU loses a heavyweight. Some estimates are that the British economy could be reduced by as much as 3.8 to 7.5% by 2030 with the exit from the EU. 50% of what the average Brit buys is imported, so the lower pound is not good, and the lower pound has been kind of what has resulted from the vote to exit. And the U.S. is a major partner of the U.K. Not so much for trade, but we're militarily and for the war against terrorism, they're important partners of ours. And also the UK is the 5th largest economy in the world, and its exit from the EU creates even more uncertainty. On the positive side, an independent UK can negotiate a deal with the EU which grants British businesses the same benefits which they now receive. Somewhat like Norway, which is not an EU member state, has the same kind of deal with the EU. So maybe that's something that could be worked out. So why are the markets falling? Why has there been so much turmoil? We have a little bit of a rally today. It's been kind of fading throughout the day, but we opened up pretty strongly. But why are the markets failing? Well, it's uncertainty. Markets hate uncertainty. It's going to be at least 2 years before any exit takes place. The UK Prime Minister has to exercise Article 50 of the Lisbon Treaty, and that is basically the article that allows nations to exit from the EU. And it takes a Prime Minister to do that. And with Cameron's resignation, it is uncertain who the next Prime Minister is going to be, and when that will take place. It probably would be the earliest this fall before there's a new Prime Minister in Great Britain. So there's some uncertainty there. The markets are also falling because the full impact of this at this point is really unknown. Goldman Sachs over the weekend predicted that the UK will be in a recession by 2017. This is unsettling to the markets. Bill Gross, who's a famous bond trader, bond manager, said yesterday that he thinks there's a 50-50 chance the U.S. goes into recession because of the Brexit. So the markets, are just unsettled here. In our country, the dollar has risen versus the British pound and the euro, and the dollar still hasn't strengthened anywhere near where it was at the height of the European debt crisis, but it has strengthened. And the strong dollar is partly causing oil prices to once again fall, which has a negative impact on corporate earnings from the oil sector and basic materials. And the strong dollar makes exports more expensive in Europe, and the translation of earnings back to dollars less valuable. So this is kind of what happened in January and February, but to a much greater degree when the market fell. We had the dollar spiking and oil falling, and there was the fear that the earnings were really going to be hurt. And some of those same fears are coming up now with the dollar strengthening again. And also the banking sector has been disrupted a little bit because they do a lot of business in the UK. So banks were one of the big losers on Friday when the market sold off. So what are the signs the crisis may be over? Probably one of the things we'd be looking for is for the Bank of England or the European Central Bank to move to stabilized conditions. Maybe the Bank of England would cut their interest rates, and maybe the ECB, the European Central Bank, would move to have more quantitative easing. Other signs that I would be looking for, or I will be looking for, is watch for talks from other countries about exiting the EU to settle down. There's been some talk from other countries that they may also want to exit, or there is that fear that that could happen. We also want to see an end to the flight to quality. The U.S. dollar and the Japanese yen have been safe haven currencies. So we want to watch for those currencies to start to fall versus the pound and the euro. We saw a little bit the euro and the pound pick up a little bit today, but again, it's trend is not made by one day, so we'll have to see what happens here. I'm not convinced things have turned around just yet. We also want to see the U.S. 10-year Treasury yield start to rise. Our Treasury bonds are also a safe haven, which has pushed yields down as foreign investors have moved to buy our treasuries during this crisis. So we want to watch for the yields to reverse, and they haven't reversed today as of yet. So we're still seeing the low yields. I think the 10 years right now around 1.46%. So investors are willing to buy a 10-year investment that's only paying 1.46%. The other thing I'll be watching for is bond yield spreads to narrow a bit, signaling that some of the risk is dissipating. So what should you do with your money? I think the first thing is don't panic. It is not time to sell, and maybe time to start putting some money to work. If you have cash that's sitting around, it may be time to put it to work. The selling may not be over, but stocks are on sale. They're certainly a lot cheaper than they were earlier last week, that is. Let's look at some of the previous crises. Japanese earthquake in March of 2011, the Japanese market was down 6% the first day. It was down a total of 16% for the full decline, but it only took 4 months for the markets to recover their losses. The U.S. debt ceiling crisis in August of 2011, the first day the U.S. market was down 3%, and the full decline was 14%. And it was just 3 months for the market to recover. And then look at the European debt crisis in March of 2012. The European markets were down 3% the first day, and there was an 11% full decline of the European stock market, and it also only took about 3 months to recover the losses. So we were down about 3.5% on the first day of the crisis. Yesterday we were down about another 1.5%. So we're certainly getting closer to a bottom. Nobody knows exactly when we'll reach that, but it's not time to panic and bail out of your positions at this time. Given that crises don't seem to last that long, it makes sense to stay in and ride it out. And this is just a crisis. I don't want to underplay it, but it is a crisis. It's not the start of a bear market or anything that's going to be long-lasting like the dot-com bubble bursting or the 2008 meltdown, which lasted more than just a couple of months. But proper diversification is designed to help weather these storms and these types of crises. Just want to add one other thing. I think the markets have been in a trading range for certainly this year, and some say we go back even longer than that, where there's kind of a downside of about 1,800 on the S&P to 2,100 on the top side of the S&P. We closed yesterday around 2,000 on the S&P, so there could be some downward pressure in the market, but the market is not ready to break out to new highs yet, and that's going to be dependent on what earnings do, and we have to monitor earnings. But earnings estimates have come down a lot this year alone since the beginning of the year. And as we move into the second half of the year, we look for estimates to be taken up, and that could be a catalyst for newer, higher highs in the market. So that concludes my comments, and see if anybody has any questions. Please go ahead and ask them.
Diana? You? No, I wanted to get, did they give you a receipt for what they did?
All right, anybody have any questions? All right. Well, this would conclude our call for the day. If there's no questions, I appreciate everybody joining us, and we'll keep you posted if as events continue, and we'll go from there.
Going to start, Anonymous?